Welcome to Quiver Financial's weekly market report for February 23rd, 2025. Big week this week, folks. We had all kinds of inflation and tariff scares that ended the stock market. Wall Street sells off on the last day of the week. Is it a market crash or is it a buying opportunity? And look what's happened in gold as it grinds higher to new all-time highs. Is it time to sell? I'm going to show you what we're looking at. And I'm going to get into this topic of why you may want to be making a plan to sell gold and not necessarily buy it at this point. And we're going to cover a lot of what we did in the past week as far as our changes in interest rates, our changes in oil and energy. So we're going to discuss a lot about what we bought, what we sold, why, what we're seeing, and more importantly, we're going to give you some actionable steps that you can get ahead of next week today. All right, so let's jump right into it, folks. We're a little bit late this week because we had a lot going on. I had a family funeral going on for my wife's 104-year-old grandmother that passed away last month. It was a great time to see family. It's good for the soul. Please give us a like and subscribe if you haven't subscribed already. I'm going to just jump right into what we're going to talk about this week. Stocks, it's been a volatile week ending on the lows. Is it a market crash coming or is this a buying opportunity? I'm going to show you the levels that matter to your portfolio, especially if you're a Quiver client. And I'm going to also talk about the sectors to watch if there is a market correction coming, because there might be a buying opportunity if you have the right kind of time frame and risk metrics in mind. So we'll cover that. Oil and energy, man, boy, you got to see this. I mean, I keep talking about this. Is oil determined to upset Trump? I mean, is it going to be the Trump administration's kryptonite? Because if there's one thing that can keep pushing inflation higher and interest rates higher, it's oil prices. So you got to see what's going on in the charts, because the last couple of weeks, we keep closing the weeks on this really important inflection point. Gold is starting to get all kinds of attention, which one of the first signs of selling is when everybody else is talking about it, you're probably getting closer to a top than a bottom. So it has grinded higher. I don't see it changing for a little while, but this is a great time to be creating a sell strategy. So I'm going to show you what we're doing for our clients. And then interest rates and REITs. The 10-year Treasury did something this week, which is a really big confidence builder if you're an income seeker or you're somebody who likes to invest in traded REITs or Treasury bonds. So I'm going to show you that because we might have something happening in the interest rate market that could be really, really good for us. I'm going to update you on what's gone on in some of the traded REITs we hold, like EPR Properties, and mortgage REITs like Annaly and AG&C, because boy, have they had a big move in the last month. So I'm going to show you that and talk about what may happen next. We always have themes. We invest around themes. Our 2025 themes is really that interest rates, the 10-year Treasury stays in this Goldilocks zone between 4% and 5%. There's a lot of good and bad news that can happen between there. If that is the case, there's a lot of reasons why income investors should be looking at things like treasuries, utilities, and traded REITs. If you get outside of that range, different story, folks, but that's the theory right now. Stock markets, we've been saying the bull is tired. I'm going to show you a couple charts, long-term charts that show you that we should be coming to a point where, equity investors should be concerned. You should be looking for value. We're holdings. We really like to focus on tech, utilities, and energy. We think there's a great tie-in between them all. So I'll show you a few charts around that. I'm also in the stock market. I'm going to talk to you about some of the sectors to watch. There's some sectors that are performing very well on the days that the market sells off. And then I'm going to give you a tariff play. I'm going to give you a play that if you think tariffs are going to continue with China, companies like Apple, Amazon, they're all going to have to work around them. So I'm going to give you the next market that may be a benefactor of that. The world of metals, like I said, the rally keeps going. We think it continues this year. However, as we move into this parabolic move, there's going to be a time to sell. And like I mentioned, oil has broken out higher earlier in this year. It's a long-term pattern that usually resolves over years. So could this be the bane in Trump administration's existence. Is oil going to be the kryptonite for Trump being able to push interest rates down and get what he wants in the economy? So let's start there with interest rates, because we believe that this is the most important story for 2025, is what is going to happen in the 10-year Treasury. If it gets above 5%, like we've been showing in this range that we've been in for almost 2 years, folks, we identified this over a year and a half ago and said if we stay in this range, then investors of treasuries, utilities, and traded REITs should do quite well. And they have since we identified that. We reached 4.76 earlier this year, which I called the danger real Robinson level. I mean, we do not want to get above 4.75. That happened a few weeks ago as we had some CPI and inflation risks. The good point of that is it gave us a couple lines in the sand. So I'm going to give you some inside baseball of how now to manage risk around your interest rate sensitive investments. You can see in this chart that we highlighted that after that little danger Will Robinson spike in the CPI report where we reached 4.65, that we wanted to get back below 4.5, because if we can stay below 4.5%, it's probably a magnet towards 4.25, and that would be great for all of us holding some interest rate sensitive investments. So what's happened since then, and what I was talking about earlier, is the nice thing about that little CPI inflation report last week that spiked rates up quickly is it gave us a risk management line, because now that 4.65 right there, that red dotted line is where, for me, in the things like EPR properties and Annaly and AG&C, and even in some of the utility stocks, if we start to approach that 4.65 or get above it, that's my first sign of risk management, that I got to start to leg out of those holdings, because they typically don't perform well in higher interest rate environments. However, if we can get below 4.4, 4.45, right in this area, then the likelihood of going down towards 4.25 is quite a bit higher. And those interest rate sensitive investments, which pay great income, may be accretive to the portfolio. So what happened this week is we started off the week with a holiday. So we have this little gap here. Rates tried to make a run higher and they stalled. This is exactly what we wanted to see. We wanted to see rates make an attempt higher and fail, and they ended the week on the lows. This is a really, really good sign, but not the final sign that we need, because now what we need is this week, we need to stay below 4.45. I wouldn't be shocked to see us start the week up towards 4.5. More importantly, we need to get to Friday of next week. We need to start March with rates below 4.4%. And if we can do that, then we have a situation where things like EPR properties, which I highlighted to you way back in the beginning of January when it was at 44, and it's ran up this week to close to 50, hitting our first target of resistance. What's surprising to me is that I thought we would hit this level when the 10-year was at 4.25. We're at 4.5, folks. So I don't know what happens next. If the 10-year does get down to 4.25, does this thing start to really bust above resistance? Normally you've got to contend with resistance for a few weeks, bounce around. So I wouldn't be shocked to see a little bit of a pullback in both EPR and also things like Annaly, which we again pointed out at the beginning of January at 18, that we'd love to see it run up to 20. And boy, did it, folks. I mean, it ran to 21.50 this week. I did not expect this to happen in 4 or 5 weeks. I think it pays another dividend pretty soon. So I'm really, really interested to see what happens with all these interest rate sensitive investments if rates can get down to 4.25. So right now, if you had good entries like we did at Quiver, we can manage this risk really well now. We've got some wiggle room, and that's great. So this next 2 weeks, we'd love to see the 10-year get lower. It looks like it's happening. If it does, I'll then give you guys some targets and actions, because it may be time to take some profits and stuff at that time. Never hurts to take profits. So let's transition into energy and oil. We had talked a long time over the last 2 years that the price of oil has been consolidating in this pattern that we call a triangle or a pendant or a bullish flag. There's a million names for it. At the end of the day, when and if this pattern breaks out, whether it's higher or lower, that usually sets the tone of the next trend, which could be multi-month, if not multi-years. So in January, right around inauguration, oil prices spike up right as Trump is saying, drill, 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 baby. And that's why we're talking about this being will this be the kryptonite for the Trump administration? Because the only thing that can really push inflation higher now is oil prices. So we spiked higher. We broke out of this pattern. That's an ominous sign for inflation. Hate to say it, but it is what it is. And now for the last 3 weeks, we've been kind of bouncing between 76 and 78 on USO. Figure it's like between $75 and $79 a barrel in US dollars of light sweet crude. And we ended last week right on that line again. Talk about frustrating. I mean, oil is just it's frustrating everybody on both sides here. So this next week, I wouldn't be too shocked to see it dip a little below that 76. If it breaks with increasing volume and you stay a whole week under 76, then we're going to have to kind of reevaluate our thesis here. However, if 76 holds and you make another run towards 78, that's probably the last pivot, right? And then you'll probably start to break out towards 80. So the next week, it's going to be really crucial to watch what happens with oil. The one tell that tells me that oil might hold 76 is the actually energy sector. So in the middle of February, we pointed out this uber bullish line. We said that if the energy sector and oil is truly like a bull move here that's just starting, then the energy sector should probably hold this little trend line that's starting here. And so 90 becomes real important in the price of XLE, and 88 is crucial. In this past week, as oil ended on the lows, energy stocks did pretty damn well. I mean, they've held that line, which I said was low probability. But right now, they've got some wiggle room here. So far it's holding, and the energy sector should still be one that's on our radar. And as most people know, it's pretty important to the Quiver portfolios right now, as we've built a pretty hefty position there. So for us, from a risk management focus, if you're a Quiver client, that $90 level on XLE is where, if we're above it, I'm happy. If we're below it, I start to think about, could the money be somewhere else and getting a better return doing something else? 88, which is this green level, is really, if we break that, stay below it, then I've got to start making adjustments to the portfolio. So we will see how that plays out over the next few weeks. Transitioning to gold here. This is GLD. We talked about it a few weeks ago and said, hey, we've had a solid breakout. Will we get a correction, a deep correction before the run higher, or will we continue to grind higher? We have done exactly that. We've ground higher. I didn't even update the chart. What I decided to do is, check yourself before you wreck yourself here. I wanted to show everybody a long-term chart of gold that goes over the last decade, so you can see that if you're a new investor to gold or silver or gold miners, you are getting in when the water's pretty deep here, because this move is pretty long in the tooth. So this is where people that, if you've been in gold, if you're not a super 100-year owner of gold, if it was a trade for you, if it was a swing trade, this is an area that you may want to start to make your plan on where you exit, because it's starting to get pretty parabolic. And the best time to make a move and start to make a plan of sell is when things are going parabolic higher, because everybody else is going to try and buy this. The other sign is now it's all being talked about on CNBC. So that, if you're supposed to buy low and sell high, you buy low because nobody's talking about it, and you sell high because everybody's talking about it. So we're starting to get into that mode where just some anecdotal sell signs are showing up. So it's time to make a plan. If you're a Quiver client and you want to know what we're doing exactly, reach out to me. If you're playing this, one thing to keep in mind is that even though gold and silver are moving, Silver lags gold, and the miners, gold miners, silver miners, they lag both the metals. So if you're greedy, if you're feeling like you really got to still get involved in this, and there could be more upside, then rather than just looking at a thing like GLD, you might want to look at GDX or SILJ or SLV, assuming that your risk can handle it. Like, this is not investment advice, folks. You have to make sure you have a good quality person like Justin, Patrick, or myself that really understands you before you take any investment advice. Don't listen to a video on YouTube and some schmuck like me and run out and start buying and selling stuff. This information is for Quiver clients, people that I know very, very well. I know every aspect of their life. And so I'm qualified to give them the advice. So let's transition after that disclosure into equities, because when it comes to gold, when it comes to energy, it's worth watching, but everybody loves equities. And again, just like the gold market, the warning I just gave you, equities are similar. It's pretty funny. Everybody talks about gold as a safe haven to equities, but look at this gold chart over the last 10 years, and look at this equity chart over the last 15 years. I mean, so risk on, baby. So if you think that gold is only a risk-off asset, not necessarily, because the charts tell you something else. So what I'm showing here is a long-term chart of the S&P 500 with some Elliott wave numbers on it. Elliott wave is a way of just really getting a gauge of how mature a move is and where a reversal may come. When you reach the fifth wave, you're coming towards the end of a growth cycle. That fifth wave could extend for a lot further. But what we do from a risk metric standpoint is when we know we're in a fifth wave, we start basically tightening up our grip on the bat. We start looking for signs like this that say, hey, retail investors are all in, because there again, if markets get pushed because more buyers are coming in, typically retail buyers are the last one in. That's been the history for 100 years. So if everybody's in, who's left to push the market higher? So these are all signs I tell people that if you're an equity investor and you have a lot of profits, this is a good time to start to make a sell plan. If you're trying to get into equities, do it slowly here, be patient. What we do is we've tightened up our bat and said we're taking this week by week. Last week, we said that we really, if the market closed on or below that 6,000 level on the S&P 500, right below it is our warning zone. Basically, that warning zone is if the market gets down into there, we're going to really reassess our long equity exposure and look for ways to hedge it. So this week, what happened? Because last week we ended the week on a very high note of confidence and said it wouldn't be too surprised to bounce around. You can see by the green arrows and move higher. And we started that this week. This week we started higher. We kind of bounced around, and then at the last 2 days of the week, things just fell apart. News came out, people did, sentiment changed. Nothing technically has broken here in equities, but it's definitely a warning sign, because now we close the week right on that warning level. So next week becomes really crucial if you're somebody who really wants to manage the risk related to equities, or if you're looking for a buying opportunity. The next few weeks really it makes sense to pay attention, because you might have one of the best opportunities of 2025 coming up here if you're on your toes. So here's the sectors to watch, because if the market does go through a deeper correction, and here's the other thing, as I'm watching markets, I'm seeing a few sectors that are going up on the days that the market went down. Like on Friday, when the market went down, the utility sector performed well. Consumer staples did incredibly well. Energy did so. But here's the sectors to watch. If you're somebody who's saying, I want to get in the equity market, but I'd like to do it in a value sector, something that pays dividends, something that it doesn't rip my face off if I happen to enter in right before a correction, then take a look at utilities, take a look at energy, take a look at miners, and take a look at consumer staples, because they're all behaving quite well on down days. Now realize, you get into a big enough sell-off in this market, everything goes, even these things. So, but if you're just eager to find something, then these are things to keep on your radar. Now, I'm going to wrap up with one thing that came to mind this weekend as I was talking to my cousin who works in the tech sector and happens to do procurement. And all of her procurement in the past was, how do you get things from China to here? She was explaining to me that the way to get around the tariffs with China is obviously to produce somewhere else. And a lot of these tech companies are transitioning to, drum roll please, they're transitioning to Vietnam, which makes a lot of sense. So think tariffs, how you get around them. You got to produce somewhere that's geographically close to China, low labor, decent infrastructure, has a relationship with the U.S. and a lot of treaties. So this is something to keep on the radar. I've looked at a couple of these Vietnamese ETFs, but they're still a little bit too early. However, if you're really somebody who likes to get in early, keep your mind wrapped around anybody who deals with textiles, anybody who deals with technology infrastructure, anybody who deals with construction of data centers. Think of anything that was built in China that may have to be reduplicated in Vietnam over the next 4 years, or anytime that we have these kind of trade wars, and you may be on to the next wave of investing. So that's just something I want to wrap up and end the week with an idea. Next week, we're going to talk a lot more about some of the sectors that are developing. If you like the video, please give us a like. It helps so much. If you haven't subscribed, please subscribe, forward it to a friend, ask them to subscribe. We're starting to get great momentum on YouTube. You're all helping us. We could use a lot more help, so keep doing it. We really appreciate it. And until next week, folks, keep a smile on your face and let's make some money.